Ladies and gentlemen, if you are one of those stragglers still on your feet, could you please take your seat as we are about to begin the final countdown to action has begun.
我哋咧呢個峰會咧就盡快，好快就會開始㗎啦。
Good morning, ladies and gentlemen, and welcome to the Global Financial Leaders Investment Summit. I am Andrew Work, and I will be your master of ceremonies as we navigate beyond uncertainty. Now, of course, the future is always uncertain, but of late, the twists and turns of economics and geopolitics have become fast and furious. And so I hope that you at least were able to take some respite from the maelstrom last night at M+. 今晚我哋嘉賓係參觀咗我哋嘅 M+ 嘅博物館咧，係證明咧係我哋喺香港好有呢個決心咧，係發展我哋文化。咁 But for almost 200 years, one city has negotiated these turbulent times and come out on top. And so it's only appropriate that we welcome you here today to Asia's financial center, so you can take stock of the global environment with a little bit of Hong Kong perspective. Now, one rock in stormy waters has been Hong Kong's famously stable monetary system.
同埋介紹我哋香港個金融嘅系統。而家咧，我哋咧就歡迎我哋香港金融管理局嘅總裁余偉文先生係支持。
Good morning, friends.
各位嘉賓早晨，歡迎大家出席我哋嘅國際金融領袖投資峰會，歡迎來自世界各地嘅朋友，我哋歡迎大家嚟到香港，係好多謝大家遠道而嚟嚟到香港，希望我哋同各位朋友同埋呢啲嘅商嘅朋友重新建立聯繫咧，大家睇到香港係翻嚟啦。
Thank you.
多謝。
And we have a saying in Chinese that in the translations like this, where the dignitaries travel, the storms follow.
即係話咧，
貴人出門一定會招風雨嘅。咁我睇到咧，出邊而家係大風大雨，不過我諗呢個係證明咗係你哋各位係喺環球呢個金融界係扮演一個好重要嘅角色嘅。咁今次係第一次我哋金管局咧係主辦一次咁樣嘅高峰會，係咁大規模嘅。如果有啲咩嘢我哋都係有做得不足嘅地方咧，係請大家係包涵。咁有關呢個高峰會咧，一個主題就係不明朗、不確定。睇下全球嘅經濟環境有好多嘅不明朗嘅譬如話滯脹啦、加息啦、地緣政治啦，同埋呢個疫情啊、氣候啊，同埋呢啲科技帶嚟嘅轉變等等。另外咧，亦都好多不明朗嘅因素。而家雖然我哋舉辦呢個高峰會，同埋我哋都面對一個好唔明朗嘅因素，就係呢個風打唔打成，不過我哋都係克服到啦。呢啲不明朗嘅情況咧係即係會過去嘅，但係有啲問題係好長期性嘅。個問題我哋要探討，我哋點樣係去處理面對嘅挑戰。
同埋譬如話喺持續發展啊、技術發展係一個兩大環球嘅趨勢。咁呢個咧係影響到世界所有地方，包括金融。咁我哋點樣去處理呢啲嘅挑戰咧？係會決定我哋可唔可以係我哋機構未來咧可唔可以成功啊？金融嘅力量咧，我哋一齊做嘅嘢事咧，係會影響到全球同埋我哋下一代嘅。咁面對呢啲咁嘅問題咧，我係期待我哋今日咧係會有一個非常之有啟發性嘅討論，同埋咧我哋可以咧從我哋金融界一啲嘅翹楚，佢哋嘅真知灼見咧係會啟發到我哋。我希望大家今日都會好好享受今日呢個高峰會嘅。多謝。
Thank you very much, Mr. Yu, for setting the stage for us today. And now we welcome the Chief Executive of the Hong Kong Special Administrative Region of the People's Republic of China, Mr. John Lee. Please.
先生。
Deputy Director Yin Zhonghua of the Liaison Office of the Central People's Government in the Hong Kong SAR,
先生
Commissioner Liu Guangyuan of the Office of the Ministry of Foreign Affairs in the Hong Kong SAR,
香港嘅
Mr. Eddie Yu,
外交部
Chief Executive of the Hong Kong
另外就係
Monetary Authority.
金管局嘅總裁
Ladies and gentlemen,
余偉文先生
distinguished guests,
各位先生、女士、各位嘉賓，早晨！歡迎大家出席我哋嘅國際金融領袖投資峰會。咁我會稱之為香港翻嚟嘅高峰。我哋係一切業務回復正常，係咁。金融投資同埋呢個商界嘅領袖，佢哋來自20個唔同嘅地方。我哋點樣稱呼佢哋講咧？大家今日嘅嚟臨咧，係即係受到我哋嘅熱烈歡迎。我諗琴晚都有喺我哋西九區嗰個 M+ 嘅博物館有一個好好嘅晚宴，同埋咧我哋香港嘅青年呢個交響樂團嘅表演，同埋樂團嗰個精彩嘅表演咧，係精彩咁反映咗我哋香港嘅精神。大家將會咧係會喺整個高峰會去感受到更多呢方面嘅精神。今日嘅主題就係點樣處理面對嘅呢個不確定性呢個情況。而家全球都係面對呢個不確定嘅形勢。我哋大家都係而家經歷一個好唔明朗嘅時間。全球咧都係咧。係面對一個前所未有嘅疫情，已經係為期3年啦，影響到我哋經濟同我哋嘅社區、政治嘅動盪同埋地緣政治嘅緊張亦都上升，亦都有通脹，全球嗰個經濟都係轉弱。雖然係咁，雖然有。
Our streets are safe, if more crowded than you may be used to. More to the point, social disturbance is clearly in the past. It has given way to stability, to growing business and community confidence in Hong Kong's future. Law and order has returned. The worst is behind us. That's thanks to the long-established certainties and unique advantages. I'm talking about the one country, two systems principle that has shaped and rewarded Hong Kong for 25 years now. One country, two systems is the unwavering cornerstone of Hong Kong. As President Xi Jinping said, marking the 25th anniversary of the Hong Kong Special Administrative Region's establishment in July, one country, two systems is here to stay, and we must adhere to it in the long run. For good reason, for all kinds of good reasons. Just 2 months ago, Canada's Fraser Institute again ranked Hong Kong the world's freest economy. Our embrace of capitalism, buttressed by the common law system, remains as strong as ever. We have adopted a low and simple tax regime, safeguarded the free flow of capital, and maintained our long-standing status as a free port. Under one country, two systems, the rule of law is sacrosanct in Hong Kong. The judiciary exercises its power independently. Fundamental rights and freedoms, including freedom of speech, of the press, of assembly, are enshrined in and protected by the Basic Law. The Basic Law also stipulates that the provisions of the International Covenant on Civil and Political Rights as applied to Hong Kong shall remain in force. That's not going to change. One country, two systems ensures matchless connectivity and opportunity with our country and with the world at large. Hong Kong's seamless connection with the mainland affords Hong Kong advantages available to no other economy. Hong Kong remains the only place in the world where the global advantage and the China advantage come together in a single city. This unique convergence makes Hong Kong the irreplaceable connection between the mainland and the rest of the world. As the center of economic gravity in the world shifts eastward, the mainland, along with fast-growing economies throughout the region, will be a major engine of global growth and an abundant source of economic opportunities. Hong Kong is perfectly positioned to reap the enormous benefits of this irreversible trend. Hong Kong has the talent, infrastructure, and know-how to help mainland enterprises and capital go abroad, while attracting international enterprises and capital into the region. That brings me to another certainty: Hong Kong's status as one of the world's leading financial centers and China's major international financial center. In 2020, our financial services contributed $76 billion. That's 23.4% of our GDP. Hong Kong has been the world's #1 IPO venue for 7 of the last 13 years. Hong Kong is also one of the world's leading biotech fundraising hubs. The total market turnover on Hong Kong Stock Exchange last year reached a record $5.2 trillion. Our banking system held assets equivalent to about 9.4 times of our GDP in 2021. Last year, our insurance sector ranked first in Asia and second in the world, with assets under management of more than $4.5 trillion. 2/3 of that funding was sourced from non-Hong Kong investors. Hong Kong is also a leading bond hub in Asia. And for the past 6 years in a row, we've been the world's largest center for arranging Asian international bonds. We were the first Asian government to issue 30-year and 20-year green bonds denominated in US dollars and euros, respectively. These are not just numbers. They demonstrate Hong Kong's immense strengths when it comes to financial services. We were, we are, and we will remain one of the world's leading financial centers. And you can take that to the bank. Hong Kong is certain to scale new heights. Charting a brighter tomorrow for Hong Kong is the theme of my policy address, which was delivered just 2 weeks ago. In it, I introduced a series of major initiatives to raise our competitiveness, create impetus for growth, and expedite Hong Kong's progress to prosperity. I should highlight that the Hong Kong SAR government, under my leadership, will take a result-oriented approach. We will focus on the outcome of policies rather than laboring away on concepts and procedures. For businesses and investors, that means we will act as leader, enabler, facilitator, and even partner in development. We will be proactive in attracting strategic enterprises and top talents to Hong Kong. How will we accomplish that? Let me highlight 3 of our new initiatives. First, we will establish a new Hong Kong Investment Corporation to optimize the use of Hong Kong's fiscal reserves and steer economic development. A co-investment fund of 30 billion Hong Kong dollars, equivalent to $3.8 billion, will be set up to attract companies to Hong Kong and invest in their business. Second, we will put in place an array of new initiatives to help enterprises, investments, and innovative professionals build a base, a home in Hong Kong. Our new and dedicated office for attracting strategic enterprises will offer special facilitation measures and tailor-made services to strategic enterprises from all over the world. Third, we will provide one-stop service for incoming talents through our new talent service unit. A new top talent pass scheme will also be introduced to entice talented professionals from around the world to pursue their careers in Hong Kong. That includes working graduates from the global top 100 universities and those earning over $320,000 a year. Hong Kong has much to offer the world. We are blessed with traditional strengths. Located at the heart of Asia, we are within 5 hours flying time of half the world's population. We have the world's business air cargo hub. We are rated amongst the easiest places in the world to do business. We are one of the world's most preferred seats of arbitration. We are the only Asian city with 5 universities in the world's top 100. Hong Kong features prominently in China's national strategies, including the National 14th Five-Year Plan, the Greater Bay Area Development, and the Belt and Road Initiative. The 14th Five-Year Plan supports Hong Kong's development in 8 major areas. These include, for example, reinforcing our position as an international financial, trade, shipping, and aviation center. One area I'm pleased to highlight is the development of Hong Kong into an international innovation and technology hub. Before year's end, we will publish our INT development blueprint for the future. It will cover major INT policies, including infrastructure, reindustrialization, our talent pool, and the development of a smart city. Then there is the Northern Metropolis. Our newest growth engine is situated in Hong Kong's northern region. It will take up an area about 1/3 the size of Hong Kong and house about 1/3 of our current population. The Northern Metropolis will become a new international INT city, an urban-rural development featuring quality housing, green and sustainable surroundings, prominent arts and cultural clusters, and a healthy balance between work and lifestyle. Its far-reaching potential will radiate beyond its geographical boundary with Shenzhen. It will create boundless opportunities with Guangdong while contributing to the overall development of the Greater Bay Area. We will also enable the continued growth of our cultural industries. Central to that is Hong Kong's rise as an internationally recognized East meets West arts and culture hub, a sophisticated global city offering world-class arts, entertainment, and lifestyle 24/7. Yes, we are opening once again for the pure business of pleasure, the pleasure of hosting and entertaining a world of visitors and travelers, arts and culture devotees, food, wine, and pub aficionados, theme park enthusiasts, sports and leisure lovers, holiday hikers, and more. You had a taste of our East meets West arts and culture last night. I invite you back to linger at the Hong Kong Palace Museum. Opened in July, it features more than 900 dazzling pieces of artifact and treasure from the world-famous Palace Museum in Beijing. And you want to stick around for the weekend and the return after 3 long years of the Hong Kong Sevens. Yes, rugby too is back, promising a long and memorable weekend of hard hits and roaring referee on the pitch and in the stands. Join us. Feel the spirit of Hong Kong on this marvelous Sevens weekend. Ladies and gentlemen, as have many other major cities worldwide, Hong Kong has been through ups and downs over the years, but our resilience remains remarkably unmatched. Consider, since 1997, we have overcome such major challenges as the SARS outbreak in 2003, the global financial crisis in 2008, most recently, disturbances and violence in 2019. Yet, our financial system has never buckled, never wavered. Like Hong Kong itself, it remains strong, sure, and enviably secure. Hong Kong always bounces back, better than ever. We have full confidence in its tenacity and its future. We are already seeing encouraging rebound as we will continue to lift our COVID restrictions. I would like to thank the Hong Kong Monetary Authority for organizing this seminal 3-day Global Leaders Investment Summit, or the Hong Kong On Stage Again Summit. I know you will make the most out of the panel sessions and discussions. After all, they are led by some of the world's brightest minds in finance. And I wish you all the best of Hong Kong's business and investments in the coming year. Before I close, I would like to tap into your success stories. Ladies and gentlemen, you are among the world's most successful business people and investors. You know full well the equation to the most promising investments: opportunity and timing. Good investors focus on tomorrow as much or more than today. They look for prospects touching bottom, for opportunities soon to soar. Look at Hong Kong. I can tell you, the worst is behind us. Opportunity and timing are right here, right now in Hong Kong. This is the moment you have been waiting for. Go for it. Get in front, not behind. Thank you. Thank you all.
Thank you very much. And as Mr. Lee said, you can take that to the bank. The only problem you're going to have in Hong Kong is trying to decide which bank. We have so many established here in Hong Kong. Now, to this day, international investors still find it challenging reading the signals coming out of China. Questions about market reform, opening up, and the long-term investment proposition for China continue to divide opinions. Now, fortunately for us, Eddie Yu from the Hong Kong Monetary Authority has sat down with the leadership of China's top 3 regulatory bodies. Now, the timing couldn't be better, given that China has just wrapped up the 20th Party Congress that will set the direction for the nation for years to come. So we are fortunate that he is having that discussion. So today, we can take some policy signals from this event and get a better outlook on China's macro and policy environment to come. So we are going to start the discussion with the regulators with Governor Yi Gang from the People's Bank of China. Please.
It's a great honor to have Governor Yi Gang from the People's Bank of China here today to talk to us about China's macroeconomic and monetary policy developments, financial market opening up, and also Hong Kong prospects as an international financial center. So, Governor Yi, let's start with a broad picture of the macroeconomic environment. How do you see the recent economic conditions in China?
I should say that the Chinese economy has remained broadly on track, despite some challenges and downward pressures. The Chinese economy has proved to be quite resilient. In Q3, the GDP grew by 3.9%, up by 3.5 percentage points over the second quarter. The job market remains stable, with a surveyed unemployment rate posting 5.5% in September. Thanks to a bumper grain harvest and a stable supply of coal and electricity, inflation remains subdued. The CPI increased by only 2.8% year-on-year in September, and the PPI increased by 0.9% year-on-year.
Well, COVID obviously has a very profound impact on global economic growth. And against this backdrop, what are your views of China's economic growth potential?
I expect China's potential growth rate remain in a reasonable range. China has a super large market, as there is still much room for urbanization, and the demand of middle-class consumers is still on the rise. Thanks to a large group of engineers and skilled workers, China has built a full-fledged modern industrial system and a high-quality infrastructure network. What is more, technology innovation in China is also on a good trajectory, and hopefully the structural reform will continue to fuel economic growth.
Well, Governor Yi, I fully agree that China's growth potential will be very promising despite the short-term fluctuations because of COVID. Now, monetary policy also plays a part in promoting growth. In the face of the various challenges this year, what's the role of monetary policy in supporting stable economic growth in China?
China's monetary policy stays accommodative to support the real economy. This year, to better support economic growth, we have calibrated monetary policy so that it would provide ample liquidity and lower financing costs. In September, broad money M2 grew by over 12%. Social financing and the new renminbi loans both grew by around 11%. Currently, the bank time deposit is in the range of 1 to 2%, and the bank loan rate is 4 to 5%. The financial market makes an efficient allocation of resources. Meanwhile, we try to utilize structural monetary policy tools providing financial support to key areas such as agriculture, small and medium-sized enterprises, as well as green development. Right now, we are also working on supporting investment in capital expenditure and infrastructure. It will show up in Q4 data.
Well, let me now turn to the RMB exchange rate, which has recently drawn some attention. How do you see the trend of the RMB exchange rate?
We follow a flexible and by and large market-determined exchange rate regime with reference to a basket of currencies. Since the beginning of the year, thanks to sound long-term fundamentals of China's economy, the renminbi remained relatively stable against a basket of currencies, with some depreciation against the US dollar and somewhat appreciation against other major currencies. In the future, we will keep on with the market-determined exchange rate regime. The renminbi exchange rate will continue to remain relatively stable at a reasonable and appropriate level, maintaining its purchasing power and keeping its value stable.
Well, Governor Yi, I think the audience today are very keen to understand what the 20th Party Congress means for them. In your view, how can China's financial industry achieve the institutional opening up that was mentioned in the report to the Party Congress?
Reform and open door policy will continue. To expand institutional opening up, they need to participate in actively international discussion on rules, regulations, and standards setting. They will continue to improve the pre-established national treatment and the negative list approach. They will also continue to improve business environment, protecting property rights, those of intellectual property right in particular, and facilitate investment in financial markets.
Well, let's now turn to another key area of focus for foreign investors, China's property market. What measures has the PBOC rolled out to support the property sector, and what are your thoughts on the outlook?
China's housing sector is linked to a lot of upstreams and downstream industries. Housing is a local market. The city government plays an essential role in stabilizing housing market in its location. To support the healthy development of this sector, we have cut mortgage rates, lowered down payments, and encourage banks to introduce special lending program for developers to ensure the timely completion of unfinished housing projects. Recently, sales and lending of real estate sector have seen marginal improvement. With ongoing urbanization in China, we hope the housing market can achieve a soft landing.
And finally, the PBOC and the HKMA, we've been working very closely together in the development of Hong Kong's offshore RMB business and also in enhancing the financial connectivity between the mainland and Hong Kong. How do you envisage Hong Kong's status as an international financial center and its role as a gateway between mainland and global financial markets?
Hong Kong is and will continue to be an important international financial center, connecting the mainland and the international markets. In recent years, Hong Kong's economy and the financial system have shown remarkably resilience despite disruptions. Hong Kong has great potential in deepening connections with the mainland financial market, financing and investing under the Belt and Road Initiative, FinTech, and green finance. To support Hong Kong's development, the People's Bank of China will continue to help Hong Kong maintain a law-based, open, inclusive, and enabling business environment and enhance its status as an international financial center.
Thank you, Governor Yi. Please join me in thanking Governor Yi for sharing his perspective. I fully agree with Governor Yi that the continued opening up of China's financial markets, global fintech adoption, and green and sustainable finance will present huge opportunities for the future development of the global financial system. Thanks very much, Governor Yi.
We now go to views from Vice Chairman Xiao Yuanqi from the China Banking and Insurance Regulatory Commission on views on China's banking sector.
Today, I'm very honored to be joined by Vice Chairman Xiao Yuanqi from the China Banking and Insurance Regulatory Commission. And he will talk about the impact of the property market slowdown on China's banking sector and also the longer-term prospect of Chinese banks. Thank you, Vice Chairman Xiao, for making time to talk to us today. Well, let me first start with the property sector, which has been a key focus of foreign investors, especially after the defaults of several large property developers. Given the importance of the property sector in the economy, how will you assess the impact of the property sector slowdown to the banking sector?
Thank you very much, Chief Executive Yu. I'm very glad to attend this very important gathering hosted by Hong Kong. I'm also very glad to have this chance to share some views about Chinese banks. Thanks for the question, very good question. That's what we are concerned about. The property sector plays a very important role in the economy. We pay close attention to its development. From the banking side, our supervision data shows that the total exposure to the property sector for the banks is, I think, is at a reasonable level. It's about 26% of the total loans. For the small and medium and small sized banks, the outstanding loans to the property sector is less than the large banks. For those banks, because for the long term, we encourage them to do their business locally and to serve the micro and small businesses. So some of the small banks, they are they're lending to the the small business, to local market, account for more than 90% of their total loans. And we also require them to comply with the concentration rules and to avoid the lending to big companies. We have the large exposure limitations. So that you are very familiar with that. In general, the property sector now is, I think, is stable. It's stable, and we are confident that the exposure for the banks to the real estate market is still very low. Non-performing loans to the property sector for the banks is about 1%. 1%. It's even less than the average level. Another point is that the majority of the lending to the real sector, to the property sector, is the home mortgage loans. It accounts for about 90%. 90% of them are home mortgage loans. Home mortgage loans is in part good quality, and the majority of the home mortgage loans are for the first house purchase. It's generally with good quality. Traditionally, Chinese banks, when the Chinese people have the tradition, they do not want to default. From our statistics, for the past 20 years, the default rate for the home mortgage loans is less than 0.1%. It's less than 0.1%. So it's very low.
Well, Vice Chairman Shao, let me now turn to the next topic about the development of Chinese banks, especially about cross-border expansion. As China's financial sector continues to open up, we're also seeing Chinese banks expanding their footprint internationally. So what are your thoughts about the longer-term development of China's banking sector, including in the international market? And how should Chinese banks raise their game and increase their competitiveness globally?
Yes, in the Chinese financial market, the foreign participants have been playing a more and more important role. I give you several figures. Foreign banks have set up 41 legal entities at the subsidiaries here, and more than 116 branches in mainland China. And recently, a large number of insurance and wealth management companies have set up. Those insurance companies and wealth management companies are owned by foreign capitals, and the foreign investors are in charge of those companies. We particularly encourage foreign capital to have cooperation and collaboration with the Chinese counterparts, or they can, in some specific areas with the wealth management, the non-performing loan coping, dealing, and transferring techniques. And also in insurance side, we hope that they can provide some insurance techniques about how to assess the cycle. Those specialists, they can take different forms of participation. They can have their subsidiaries 100% of the ownership, and they can set up branches, and they can also acquire some ownership with the Chinese banks, Chinese insurance companies, and the Chinese wealth management companies. They can take different forms. About Chinese banks overseas expanding, they do have a number of banks, mainly the Big Four, have overseas presence, including branches and subsidiaries in some countries. But the total assets for those banks overseas is about 15 trillion yuan, equivalent to 2.5 trillion US dollar. Still a small percentage in comparison with total assets of Chinese banks is more than 400 trillion yuan. So it's about 3.5%. So in terms of the overseas assets, the percent total assets of Chinese banks is still small, 3.5%. As a regulator, we support the Chinese banks to go abroad to do their business. But we have some reminding for them. For example, they need to well serve their customers to achieve commercially sustainable development, to know what the customers need, to know what the local economy need. Because to go to overseas, each regions, each locations are different. Customers are different. Their needs are different. So the first is to know what the customers need is. Ensure that the local customers' needs could be met. The second is to very important is to comply with the local or the host authorities' regulations and also international standards, practices. In different locations, regulations and our supervisory rules are different. Even the supervisory methodology, techniques are different. So they need to adapt to those requirements to in compliance with the local monetary requirements. So that I think they should do so at any time in any place to ensure that the compliance risk is under control. The third one I think is to develop risk management framework and to enhance the risk management capabilities to ensure the quality risk, the liquidity risk, strategic risk, and also the market risk, any risks for the banks. And also the social responsibilities is important to do more climate change, to be more supportive for the green finance and the inclusive finance. For Chinese banks, we encourage them to attract talent for senior managers, particularly from all backgrounds, particularly those talents have local experience, have international experience to help and to up their games, to more adaptive to the international market, to local market. Those are very important. When I have the prudential meetings with the boards or the senior managers of the banks, I always remind them to have local or international talents come to the board, to senior manager positions, to diversify the composition of the senior manager team. That will benefit from them going abroad more prudently. Yeah.
Thank you very much, Vice Chairman Xiao. It's a great discussion. My own take is that Chinese banks' risk exposure to the property sector are relatively limited, and the risk is manageable. And of course, there will be near-term headwinds, but the Chinese banking industry, as I see it, will continue to play a very important role, not just in supporting industries domestically, but as you said, they will continue to expand their global participation in the way that you described, and with your guidance. Finally, I would like to thank Vice Chairman Xiao for sharing his insights. I'm sure that our audience will benefit from it. Thank you very much, Vice Chairman Xiao.
And now, going to the third of our three people from the regulatory bodies in China, we welcome views from Fang Xinghai, who is the Vice Chairman of the China Securities Regulatory Commission, to talk about recent developments, including the opening of China's capital markets and a special role for Hong Kong.
I'm very honored today to be joined by Vice Chairman Fang Xinhai from the China Securities Regulatory Commission. He will share with us his perspective on the direction of market opening and also the role of Hong Kong. Thank you very much, Vice Chairman Fang, for making the time to speak with us today.
Good to talk to you, Chief Executive Yu. Thanks for the invitation.
Let me first start with the topic of market access, which is of great interest to our audience today. Despite COVID, in the last few years, we are seeing the continuing opening up of China's financial market, including the continued expansion of the various connect schemes between the mainland and Hong Kong, the removal of foreign ownership limits, and also other enhancements. In fact, a lot of progress has been made in the security sector to allow foreign firms to play a much bigger role in the Chinese market. For example, the removal of foreign ownership restrictions on futures, securities, and also fund management companies. How do you see the prospect of these companies' business in China?
Well, first of all, we opened up our capital markets because that is good for China. They need high-quality institutions to play in this market. I mean, China has a huge market, and we have a lot of investors, but we still do not have enough high-quality institutions, like securities firms, futures brokers, fund managers. So by attracting first-class international players into the market, it's very good for China. And we also have a vision that opening up our markets to international participation will be good for the rest of the world. China, will remain a major driver of economic growth for the world. And we want to share our growth with international participants. That is our vision. That is President Xi's vision. We want to share China's growth with the rest of the world. So with these in mind, our opening up policy is on a very firm foundation. And happily, we have seen very enthusiastic response from international institutions. Many of them have already come into our market, and many of them are in the process of preparing and applying to come into our market. We welcome them all. And for those who have been here, I can say most of them have done very well. Their progress in China has exceeded their plan, exceeded their expectations. So we continue to welcome them in.
Thank you very much for your very upbeat explanation of your policy. Next, I would like to focus a bit more on a topic that is closer to home. You recently spoke about the CSRC's new initiative to strengthen mutual access between mainland and Hong Kong's financial markets, including, for example, broadening the scope of the Stock Connect and also the introduction of the mainland government bond futures in Hong Kong. How do you think these measures will enhance the appeal of Chinese and RMB-denominated assets to foreign investors? And what are the implications for Hong Kong? This is something that, of course, understandably, I'm interested in.
Yeah, sure. At the CSRC, we see Hong Kong as a very, very important international financial center for China. And of course, for the rest of the world. China wants to develop what we call a high-quality economy, right? And for a high-quality economy, you must have a high-quality capital markets. And so we are here at home, we are full speed ahead in terms of building up a high-quality capital market. But that takes some time. And Hong Kong is already a high-quality capital market. So for China's economic growth, we need Hong Kong. Hong Kong can play a very important role in help grow the Chinese economy. And so because of that, the CSRC is fully behind our central government's policy of grow the Hong Kong financial market even more and make it even a stronger financial center. And that is why about a month ago, or a little bit more than a month ago, I, on behalf of the CSRC, announced 3 major policies to support Hong Kong's growth as a financial center. Among these, I think 2 of them are extremely important. One is, to allow the Connect to cover truly international companies that are listing, that are going to be listed in Hong Kong. Some of them, of course, are already listed in Hong Kong. And that would allow mainland investors to access these international companies. And so that will help a lot Hong Kong's ability to attract these major international companies to list in Hong Kong. The second policy is also very important. Is the relaunch, I would say, of the Treasury, the Chinese Treasury bond futures market. Chief Executive, you just mentioned that Hong Kong has this vision to become an offshore RMB financial center, right, where international investors can access RMB assets in Hong Kong. And we support this vision. So with that, Treasury futures market, a Treasury futures contract being traded in Hong Kong, that will help a lot the international investors' risk management. And that will also by itself help enhance the entire financial RMB financial market in Hong Kong. It will help pricing and so forth. So these are very important policies. The third one is to allow Hong Kong to set up what we call RMB counter in the stocks listed in Hong Kong. So for these large stocks, they will have both RMB trading as well as Hong Kong dollar trading. So these 3 policies put together, I believe, will help Hong Kong quite a lot in terms of realizing Hong Kong's vision of becoming an even more important financial center. And that would also attract more international investors to come to Hong Kong and invest into these RMB assets. Now, let me add one thing. In order for Hong Kong to become a major offshore, or maybe even the most important offshore RMB financial center, I think ultimately it will depend on how successful the Chinese economy will be, right? And on that, I'm very confident. International investors should read more carefully about the work report that President Xi delivered in the recent 20th Party Congress. There, he re-emphasized the centrality of economic growth in the entire work of the party and the country. And that's very significant. And that will, it has been the case in China, and it will continue to be the focus for China for the foreseeable future. We are fully focused on economic growth. And also, but then people would ask, how do you grow the economy, right? And it's simple. Our past 40 years has already pointed the direction, which is market-based reform and opening up to the rest of the world. So President Xi, re-emphasized the centrality of the market mechanism in allocating resources in his work report. And he also said pointedly, at the end of the Congress, there was a press conference. I hope people noticed that. Right? There's a press conference where he restated that China's door of opening up can only be bigger and bigger going forward. And Hong Kong will play a very important role in the overall opening up of China's economy, as well as, of course, the Chinese financial sector.
Thank you for this last comment, especially about the centrality of economic development in President Xi's work report, and also his emphasis on the market mechanism and the continued opening up. I think these are very, very important messages for our audience today to take away and for the broader audience to really understand. That's extremely important.
Let me also add, I deal with international investors quite a lot in my daily work, right? And I'm afraid some of them have read too much the international media report about events in China, because a lot of media reports, they let me put it this way, they really don't understand China very well, and they have a short-term focus. And I would advise, the international investors to find out what's really going on in China and what's the real intention of our government by themselves. Don't read too much of these international media.
and I think today's communication with you will help a lot in extending this direct message from Beijing to the audience here. So thank you very much, Vice Chairman Fang. Sure. And I'm sure that our audience will be benefited from your insights. But my own take is that, well, we're faced with very uncertain external environment. We're bound to see short-term market fluctuations, but that will not reverse the long-term appeal of China's capital markets or China's opening up, like what you just said. And Hong Kong's unique role in connecting the world and the mainland will continue and remains very important, and there will be new exciting opportunities for us. I think that's an important takeaway.
I totally agree with you. Don't bet against China and Hong Kong.
All right. Okay. Thank you very much, Vice Chairman Fang. Sure. Okay. Thank you.
Talk to you later.
All right, and thank you again, Mr. Yu, for putting that collection of views forward. Those are exactly the kind of views that we need going forward to be able to navigate through uncertainty. So we're very fortunate to have them. We are going to take a very brief pause to let the Chief Executive take his leave. He has other pressing duties he needs to attend to. So once again, Mr. Lee, we thank you for joining us today. And you take care of Hong Kong through this typhoon. Thank you very much for joining us today. Thank you, Mr. Lee. While we begin to effect the transition here on stage to move to the next phase of what we're doing, I'm going to let some of you in on a little bit of real Hong Kong insider that you need to know. If you know this thing, people will know that you've got, you're kind of a little bit of a Hong Konger yourself. Right now, there is a typhoon raging outside, not the metaphorical one about the markets, but an actual typhoon. And here in Hong Kong, we have categories of typhoon. Now, for those of you that want to track what's going on, you Google HKO for the Hong Kong Observatory. At the top of the front page, there will be a symbol and a number. And the number is what you are looking for. T1, nobody cares. Hong Kongers, ignore it. T3, things are getting interesting. There's no T2. Nobody knows why. Nobody cares. So T1, nobody cares. T3, things are getting interesting because the next level up is T8. What happened to T4, 5, 6, 7, 7, 8, 9? I don't know. Again, nobody cares. But T8 is when it gets interesting. That is when schools get closed. People don't have to go to work. But good news, the cinemas and the malls stay open. So first thing in the morning, all the seats are available for booking. As soon as the T8 gets declared, all the movies are sold out all day across Hong Kong. So if you want to be a real insider, track the Hong Kong Observatory and you'll be able to see what's going on with the typhoon because you might get lucky for a T8 today. Just to finish that off, if it goes to T9 or T10, that's when things get serious. And people say, whoa, this is the real deal. And if you're a lover of intense weather like I am, try on a T9 or T10 for size sometime. It's an amazing thing to see. And with that, we are ready to proceed to our next panel, and we are going to be discussing navigating through uncertainty. Our panelists coming up here today are the captains of the biggest financial ships on the seas. Not even the ships. They are the commanders of entire financial armadas. And we are thrilled to have them up here today because they have the skills and experience and insight that we need to move forward. Leading today's panel, I'd like to welcome our moderator, the Chief Executive of the Hong Kong Monetary Authority, Eddie Yu. Eddie, if you could lead this charge, please. He is going to be joined by Michael Che, who is the CFO and Senior Managing Director at Blackstone. Next up, we welcome James Gorman, the Chairman and Chief Executive of Morgan Stanley. Following him is Colm Kelleher, the Chairman of the UBS Group AG. Thank you, Colm Kelleher, for joining us on stage. We next welcome Liu Jin, the President of the Bank of China, on stage. And to complete our panel, we welcome David Solomon, the Chairman and Chief Executive of Goldman Sachs. And with that, Mr. Yu, the ship is yours to command.
Thank you very much. The theme of this first session is about navigating through uncertainties. And just now we talked about it quite a bit. The macro risk, inflation, slow growth, high interest rates, geopolitical risk, and even pandemic is still lingering around, and they're all impacting both financial institutions and your stakeholders and your clients, the corporations. And today we have a very, very heavyweight panel to talk about how they navigate or how they help their clients and stakeholders navigate through all these uncertainties. And I will just start because we can't wait to hear from them. I will start with the corporate perspective. So, James, you've been talking to CEOs around the world, whether they're big business or small enterprises. And how are your clients navigate this period of slow growth, rising inflation, much higher cost of capital? How do you see the global macro outlook? And do you see any bright spots?
Well, good morning. That's a lot to chew on first up, but let me try. I mean, firstly, context matters. What we're going through economically now has its roots in the financial crisis. That led to a decade-long period of stimulating policy, monetary policy, and effectively zero interest rates around the world. That was abnormal. Along the journey of the last decade came COVID, and obviously led to a global shutdown. Global GDP was negative 30% during the second quarter of 2020. That was obviously extremely abnormal. So we've had the two largest shocks to the economic system in the last decade that we've probably had in the last 70 years. It's not surprising that right now the markets are having trouble adjusting to that. Nobody should be surprised that interest rates are going up. They're abnormally low, and reserve banks around the world are trying to get them back to some level of normality and even higher for a period because of the rise in inflation. So, listen, for chief executives of large and small companies, the issues are profound. Dealing with uncertainty, however, is part of one's job description. So, to start with some of the narrow issues is just what are your COVID policies? What are your protocols about having people back working together? That of itself, and the change in the dynamic in the office space. Secondly, how do you navigate financially a period where what was much cheaper money is less cheap, and it changes your financial position as a company? How do you adjust to that? Thirdly, we're dealing with wage inflation across every part of the world. For the emerging markets, we've had wage inflation for several years. Now we've got it in the developed markets. That's another challenge to add on. And you've got broader supply chain issues and supply inflation because of some of the geopolitical issues that are going on around the world, and post-COVID, the impact on the supply chain. So, and I could keep going, Eddie. There are many issues to deal with, but this is it's a painful transition, but it's not an unexpected transition. And I think we have to keep that in context. My gut is the central banks will, in aggregate, tame inflation. I think it's highly improbable we'll get back to the kind of 1-2% inflation we enjoyed before this crisis, more like around 4% over the next few years, and we'll have to deal with that. We'll have interest rates somewhere between 4 and 5%. We'll have inflation around 4%. This is globally, and obviously unemployment is going to tick up during this period. But listen, this is our job to manage through uncertainty, and you have to accept the market as it is and accept reality and not fight reality.
Thank you, James. I totally agree with you that the past few years probably was a bit abnormal, and we are now really just going back to normality. But that path is painful, causing volatilities in the capital markets around the world. And talking about that, I will now turn to David. Because of these volatilities, we are actually seeing the IPO market globally really dwindling, the corporate bond issuance coming down, it's not performing well. You know, when you talk to the CEOs around the world, what do they tell you about capital flows? And does that sentiment suggest when capital markets activity will pick up, how it will look like in the near future?
Well, thank you for the question, and good morning, everybody. You know, if you listen to what James, just walked to, James describes a period of change and a period of uncertainty. Capital markets are highly, highly geared to confidence. And we happen to be at a moment in time where there's greater uncertainty, and the trajectory of economic growth, the trajectory of interest rates are all more uncertain than they've been in quite some time. So it's not surprising in that environment the capital markets activity has really decreased. You know, history would tell you that when you go through a transition, you go through a change, market participants, capital allocators need time to adjust to that new reality. As James highlighted, we've gone through a decade of very, very easy money, very, very accelerated asset price appreciation, and so you were generally rewarded for deploying capital and deploying capital aggressively. You're now not being rewarded for that, and therefore investors want a much more significant discount, a much more significant risk premium if they're going to deploy capital. One of the riskier things you can do is participate in an IPO, deploy capital at a new company that's unproven, that doesn't have a track record. And so obviously those risk premiums are up very, very significantly. Generally speaking, when we've had these periods in the past, it takes somewhere between 2 and 4 quarters, sometimes maybe 6 quarters, to rebalance. I think we're going through that rebalancing period. I think there's still a significant amount of uncertainty, but as we get into 2023 and we start to have a clear understanding of the trajectory of capital markets, I think you'll see issuers and capital allocators meet again in the middle, although at different valuations and a different cost of capital than they've operated with over the course of the last decade. So I think we're in the process of that journey, and my expectations is that equilibrium will come more into balance in the coming quarters.
Thank you, David. Let me now turn to President Liu. Of course, China's economic growth, what's the macro outlook in China, and also the outlook for particular sectors, especially the real estate, is something that is of a lot of interest to our audience here. So can you give us some comments on the China macro and also the real estate sector in China?
Thank you, Eddie, for your question, and good morning, ladies and gentlemen. This is a good question. Looking into the economic future of China, I think we'd better find answers from the just concluded National Congress of CPC, because everybody knows that it has been made very clear to the world. The leadership of the party is featuring characteristics of the Chinese social system and a major driving force of the Chinese economic development. We say in the Western context, when in Rome, do as Romans do. I would like to suggest that when in China, think as the Chinese do. So in his address in the Congress, President Xi emphasizes many times the high-quality economic development, the high-level opening up, the centrality of an economy and sustainable growth. Obviously, since the beginning of this year, China has experienced headwinds in the economy because of the COVID, on and off COVID outbreaks and geopolitical tensions. But with the government sustained efforts, with the continuing optimized solutions and COVID strategies, with the moderate inflation and macro economy monetary support, together with the additional efforts from the financial institutions, we see a rebound of economy in the third quarter with 3.9%. That is a good signal in the Chinese economy. So that's why I would like to rely on the fact that in the future, China, the country, will stick to the centrality of economy, and we see a bright future of the economic development. So our theme of the discussion today is navigating through uncertainties. The storm today is one of them. And I would like to suggest that the best way out of all the uncertainties is to find out and focus on what is still remaining true and certain amid all those uncertainties. For example, it is certain that the economic cycle of expansion and contraction will always dominate the global economy. It is certain that Hong Kong, as a financial center, worldwide financial center, and the important hub of mainland China and the rest of the world, will always remain, with the hard effort and grand plans made by the Hong Kong SAR government, especially in the recent policy address by John Lee, the chief executive. It is also certain that Bank of China, with a history of 110 years, here in Hong Kong 105, will work together with all the international financial institutions to support the economic growth, to support the international financial cooperation, to support the international trade. So all these certainties, just now in the address of John Lee, the chief executive, he listed a couple of hard times Hong Kong experienced in the past decades. But as I remember, ahead of and in each of the hard times, some people just left and came back. A lot more stayed in Hong Kong. And finally, they welcomed the new era, the new development together. That's the certainty of Hong Kong. That's the certainty of the Chinese economy. So once we understand well and grasp all the certainties, we can always find new ways to cope with the uncertainties. Thank you.
Thank you. So don't bet against China and Hong Kong, right? So let's turn to the investor perspective. Let me come to Colin. With all these uncertainties in markets and the macroeconomy, when you talk to your institutional investors, clients, and also the wealth management clients, how is that affecting the investment preferences and also the risk appetite? And in dealing with high inflation, rising interest rates, have they made any changes to their asset allocation strategies, or whether even in this kind of investment environment, do you see them go into certain areas, whether in traditional or in alternative investments, that might offer them good returns? Colin.
First of all, I don't have to agree with James anymore, but I will agree with James in that his summary of the great unwind is very accurate, and that's exactly where we are these days. We have record levels of cash in our global wealth management accounts, and in our US wealth management, as James would agree, we've got very high levels of cash too. So clients are clearly on the sidelines. You've had, over the last 9 months, pretty dire returns in both equities and fixed income and commodities, except for selective spots. I don't think, however, we've had a capitulation trade. What we've had is people waiting to reallocate and get some certainty about direction. And I think James is right. There is a feeling that, the central banks will get this under control, and then there will be bright spots for investing. We're not seeing it yet. However, we have seen earning multiples in the US beginning to be revised. Valuations are beginning to attract money in certain areas, consumers, healthcare, for instance. Commodities is a selective case for people to look at. If you look at UBS's investment recommendations, we're pretty much neutral or light every asset class at the moment. But on the other hand, if you look out over the next 9 months, you can see projected returns actually looking quite attractive, not surprising given the base we're at currently. I think the world, however, is 3 parts. Whilst I think we agree the US is relatively attractive on a comparative basis, I think Europe has very big issues, not least of which is a declining size of equity market, but also banking union has ground to a halt in Europe, which means that you've got wrong way risk in the banking sector, which means that it's very hard for the economy itself to grow. And China is, whilst we're all very pro-China, and like Vice Chairman Fang said, we're not reading the American press. We actually buy the story, but it is a bit waiting for zero COVID to open up in China and to see what will happen. The only other thing I would add is that there's clearly been a big investment shift in terms of the way people are investing, and that there's more of a barbell strategy now. Alternatives are clearly becoming a very big sector for people to invest, and we're beginning to see significant demand for alternatives through our network. And I'm very pleased to say that the alternative managers are being very nice to UBS about selling their products through our network as well. So,
thank you very much, Colin. And that leads very nicely into alternative, especially the private markets. We've got Michael here. Michael, how do you think about the private market performance during this period of big market volatility? Has the public market volatility trickled down into your investments? And also in the private market space, where are the opportunities that you think are the most sort of valuable or the best ones? Michael, please.
Sure, Eddie. Good morning, and thank you for having me set up by Colin, and we'll continue to be nice to you and your colleagues, Colin. I'd say first, with respect to the private market dynamics, while private markets are obviously, not immune to what's going on, as you know well, they operate differently than the public markets. They don't swing up and down with the same sort of euphoria on the one hand and depression on the other. They are less volatile by design, and both on the upside and downside. And over time, through cycles, they've consistently outperformed public markets, which is why investors are so willing to, trade liquidity for that outperformance long term. Against that backdrop, we bring a business model that has some structural advantages, long-term locked up capital. We have dry powder of about $182 billion today, and a long-term sort of buy and hold mindset. And for us, after sort of 4 decades of operating through dislocations, we've tended to come out stronger. I think in terms of some of the trends we're seeing in our portfolio in generally, many parts, echoing what others have said, many parts of the economy are still running pretty strongly, though there's clearly deceleration. We're seeing, the Fed's actions and other central bank actions, filtering into the real economy, but on a lag. and we're beginning to see the slowing of both inflation on the one hand and growth on the other. But the extent to which today really depends on sectors. So, at the tip of the spear, you have sectors like for-sale housing and its related ecosystem, which I think have been most immediately affected by this sea change in cost of capital. The sort of discretionary digital ad spending world is seeing a meaningful slowdown. But on the other hand, in sectors, including ones where we have a lot of exposure, whether it's travel or energy, both traditional and transitional, rental housing, logistics, you're still seeing continued strength, and that's because demand is still pretty robust and there's still shortages of supply, in some cases structural shortages of supply. So, it's a mixed picture that we see. There's a clear deceleration, but, the key tension, I would say, is that we still have a pretty tight labor market, and we're seeing, wage increases in sort of the high single digits. And that combined with, continued rental housing strength, I think means you've got a couple major components of inflation that'll continue to be sticky, and that'll complicate, the Fed's calculus from here. And the result of this is uncertainty and rising caution, and I think, you'll see that reflected from our perspective, among corporates in slowing hiring, more caution around investment spend going into the new year and so forth. To your question about, compelling opportunities to put capital work, I'd cite a few areas. First, lending money. Providing private credit to borrowers. It's a highly attractive environment for that. You obviously have, floating rate debt, higher base rates, pretty attractive spreads, senior debt in the capital structure at pretty reasonable loans to value, and in our model, a buy and hold to maturity. And so this provides an excellent risk return, in this part of the cycle, always has, and it will here as well. Second, I'd say investing in hard assets with short duration income streams. In our real estate business, as large as it is, about 80% of it is in sectors, that have rents growing at multiples of inflation. In our infrastructure business, that portfolio is performing really well. So that remains, I think, an area of strength in a rising rate environment. Third, within sectors like technology, life sciences, you've got, the innovation, underlying innovation continues, but excessive valuations have in many cases are now a thing of the past. So we'll see, I think that'll create opportunities over time. And then finally, just around public company situations, I would say, given the dislocation, while you might not see at this stage, public to privates from firms like us, you will see divestitures, carve-outs, what we call corporate partnerships. We announced a transaction on Monday with Emerson Electric that we're happy about. That I think is a good example of that. So I think you'll see more of that. So, I think it's simple. In an environment where access to capital in the public markets is constrained, the ability for private capital to provide capital solutions is a really important thing to the system. And for us, our business is simply, an at-scale capital solutions provider across multiple asset classes.
Thank you, Michael. Obviously, even in this period of volatilities, there are areas that we can explore in terms of getting reasonable risk-adjusted returns, like private credit and infrastructure, like you said. Before I turn to the floor for questions, I have one quick question for all of you. We are continuing to look at risk in the financial system in the world. We don't know where the fault line is. We don't know where the next black swan is. So for you, what's the one biggest risk that you might see that might keep you awake at night? I know you all sleep for a while at night, but if there's one big risk that you will name for us that we should watch out for, what is it? So shall we start with James first again?
Sure. I think it's inflation. We haven't had this level of inflation in 40 years. I believe the Federal Reserve and other monetary authorities kept rates too low for too long with too much QE. It's an art, not a science, in juggling where rates are supposed to be relative to unemployment, relative to GDP growth. And the probability of us hitting exactly and nailing inflation without bringing unemployment up too much, but keeping GDP growth, it's hard, right? So I think my gut is we're getting there, and some of the early signs on demand side inflation are suggestive of that. On supply side, less so. You can't really control gas prices out of, what the impact of gas out of Russia is for the global economy, but it's inflation. If we nail that, this is going to be fine.
Thank you, James. David?
I'm going to echo a little bit about what James said. Obviously, if central banks find a way to tame inflation, that, meaningfully, they do it in a balanced way, it meaningfully increases the chance of a soft landing. But we spend a lot of time looking at the fact that we're materially changing the market structure that we've lived in for a very, very long time. We've had relatively accommodative monetary policy for over a decade, almost free money. But generally, the trend over the last 40 years has really been for increasingly accommodative monetary policy, and therefore, very, very strong asset price returns. Central banks have supported fixed income markets in an enormously aggressive way. You've had a significant amount of quantitative easing. We're now in a period of quantitative tightening. And all of this, combined with inflation and a very quick tightening of monetary conditions, makes the world more volatile, more uncertain, and it also allows exposures where there's leverage in the system to be amplified very quickly. Right. We saw that in the UK. I think that's a good window into the kinds of things that can go wrong if there are liquidity squeezes or liquidity traps in markets as we tighten conditions. And so I think you've got to watch that all very, very carefully.
Thank you, David. President Liu, what's your thought about the risk on the horizon?
First of all, I'd like to say I slept pretty well in Hong Kong in the past 2 days. And if I had one or two concerns of risks, the spread of geopolitical tension would be one. Anyway, under the geopolitical tensions, any of our economic activities will be heavily affected. By the way, we talked much about the risks in the property market in China today. Let me share with you some of my observations and understandings about it. Last year, since the second half of last year, we did have some problems in the property market. There have been some developers tangling with liquidity problems, construction suspension risks, and even bank loans defaults. But finally, with the government's support, government enhanced oversight of property sales, and the government help in the address of the property-related, developer-related risks. The market is coming back. What we are saying and what is actually expected of by the government is warming up, coming back, better property market. We are pretty confident about it. And I'm sure that nobody than the Chinese government, than the Chinese banks, cares more about the property market because it has too much to do with the manufacturing industries and then the GDP growth with the financial stability. So don't worry too much. As Mr. Fang said, don't read too much negative reports.
Colin?
What keeps me up at night is the question. It reminds me of a story about Marlon Brando at the Lee Strasberg acting studio. And he was told by Lee Strasberg, "You're a chicken, there's going to be a nuclear attack." So all these other actors were running around panicking, and Brando was just sat there clucking. And Strasberg said to him, "What are you doing?" He said, "I'm a chicken. What do I know about nuclear attacks?" The point I'm making is I can only worry about what I can control. And the only thing I can control with Ralph is the health of our bank. So everything else kind of lets me sleep at night. I can't control inflation. I can worry about it. I can't control the global thermonuclear war. So in many ways, I sleep pretty well. Thank you.
Thank you, Colin. Michael, anything?
I'd simply say what keeps me up is the possibility of rising tensions around the world that could lead to serious threats to stability.
Geopolitics as well. So let me open the floor for questions. Before you ask your question, please say your name and also your institution. Yes, one over there.
Thank you. I'm Henny Sender. This was a wonderful discussion. What I wanted to ask you about is where we all went wrong before COVID, when we all thought that technology would be profoundly deflationary, that as the sharing economy meant that, say, cars would go from being a thing to being a service. We thought the issue would be excess labor rather than a labor shortage. To what extent do you think that COVID has just totally made for a secular change, or is it only temporary before we see these deflationary forces coming back into?
Why the sudden swing? Maybe James, you talked about inflation earlier. Any thoughts on that question?
Henny, I think the period we went through with COVID, and we're obviously still going through here, and the constraints and controls and the impact it has on the economy it was life-changing. The last time we had a global pandemic, I think, was 1919 with the Spanish flu of this magnitude. Obviously SARS, MERS, but a global synchronized pandemic that caused GDP growth to be negative 33%. So that's the kind of shock that for all the technology changes that have taken place, it clearly was going to disrupt that. But now we're getting back to normalization, and I think you're seeing unemployment starting to tick up globally. You're seeing some increase in worker participation, people who sort of the so-called great retirement, as people survived on various government payments, realize those payments have now stopped. You've actually got to go back to work if you're going to pay for your mortgage. We're seeing, so as a result, we're seeing more competitiveness in the labor market, and I think wage inflation will come down. And the digitalization of the economy and the technology changes are not for nothing. There was a lot of hype going into it. There were companies trading at 50 times revenues, which is just insanity. So that's been flushed out, but that doesn't mean the whole digitalization of the economy got flushed out. So I saw it as, you know, clearly the kind of unknown that not even Donald Rumsfeld might have conjured up COVID, and here we are now, and I think we'll get back on track. Subject, of course, to geopolitical and other things outside of the direct economic factor.
Anything to add from other panelists on this point? If not, then I'll turn back to the floor. Yes, Raymond? The mic's coming.
Thank you. Raymond Chow, PwC. And thank you for that conversation this morning. That was wonderful. My question to the panel is actually, we talked a lot about the uncertainties and the risk, which I agree 100%. The one thing that I want to ask the panel and your view on is we didn't talk about ESG. One of the major issues facing the world in the medium and the longer term is obviously ESG issues, and specifically climate issues. And given the many risks that we just talked about, how your view in terms of the financial market, and are we slipping in terms of our focus of building sustainable finance and sustainable growth in the longer term because of these short-term risks that we're focused on, whether it's inflation, whether it's recession, et cetera, that we might have lost a bit of focus of working together to build a sustainable future?
Thank you. Especially when we see energy prices going all the way up. Are we losing track on ESG? Maybe Colin?
I certainly don't think we are. There are short-term challenges. However, we know what ESG is. What we're waiting for as financial intermediaries is codification, the rigor and the regulations that go around it so we know what we're reporting, right? So in many ways, it's very loosely defined at the moment, as you know, right? And there's no real accountability as yet. Saying you're going to be a leader in ESG is one thing. Saying you're going to be top 3 in ESG, what does that mean? So we're waiting to see what various regulators, commissions, we know the gestures of intent from the UN, from the EU, and from others. We're waiting to get actually hard codification of this to come through from people like the SEC, the CFTC, and other regulatory bodies. Our investors clearly are focused on this. So this is not going away. This is thematic. And in many ways, the sooner we get clarification, the better for all of us. And, you know, we already have generated a huge amount of ESG funds, or whatever. We have to make sure, though, that investors understand that these are correctly identified. You don't fall foul of the greenwashing charges that have happened elsewhere and so on. So I think this movement is totally unstoppable, and it's what Generation X, Z, millennials, etc. want. Yep.
Thank you, Colin. James, you want to add?
I think it's, as I said at the outset, the list of things that we're worried about is long, and it was an incomplete list because we've got to focus on the immediate to sort of get through this. The ESG focus, I just came out of a board meeting. We discussed it in the Audit Committee, Nominating Governance Committee, Risk Committee, and with the full board. It is part and parcel of what every company is doing. But I think more recently what we've seen directly is the impact on German industry and particularly European energy prices as a result of the war, the Russian war in the Ukraine. I think that ironically set back the ESG debate one step and propelled it 2 steps. The step back was obviously, well, you can't have the economy collapse. You need to find energy, whether it's brown energy or clean energy, you need energy. The 2 steps forward is you better figure out a way to create energy supply which you can control and is not dependent upon somebody else cutting off pipes or pipelines. And I think, you know, look at the difference between the way the French position now versus Germany in the relative energy positions of those 2 countries, nuclear versus gas. So if anything, I think it's become, it's accelerated the discussion of ESG the recent period. But it's not something as CEOs that we can do something about today relative to making sure your organizations survive this period of transition that we're in. But it's always there on the table.
Thank you. I'm glad that the momentum is there. President Liu?
I agree with those comments, and we have never stopped our ESG steps during the hard COVID time. As a matter of fact, in China, in mainland China, ESG and sustainable development has become more and more popular. You know, MSCI, I'm not sure whether you are here today, and you have become more and more popular and welcomed in China because of your excellent ESG professional service. And in the past 3 years, a few of our customer managers are meeting in person with our clients. But we do a lot of sustainable development research, especially concerning the coal mining industry and iron and steel industry. You know, sustainable and green development is a big idea. We have to go into details. I asked my colleagues to go to the iron and steel factories and mining coal mining fields to identify which particular part of the factory belongs to green field, which we are going to make further loans to. So after 2 years' effort, we have achieved quite a lot than before. Thank you.
Thank you. We still have about 5 minutes, so maybe one more question from the floor. Yes, over there.
Hi, Brian Sack from D. Shaw. So it sounds like the panelists agree that even if central banks do their job and address the situation, we're going to come out on the other side of this with a higher average level of inflation, a higher level of interest rates. What I wanted to ask is, what's the degree of uncertainty and volatility in that state? Can we get to a world where volatility, we sort of settle down around this higher level and volatility actually comes back to the low levels we saw over the past 15 years? Or does the high level of inflation and interest rates automatically go hand in hand with a much more volatile environment than what we've seen in the past couple of decades? Thank you.
Any thoughts from our panelists? Maybe I should start from David.
So I appreciate the question, and it's a very good thing for all of us to think about. It's very hard for us because we've been living in a world where money's been so free, and the tailwind of free money, has had such a consistent impact on asset prices in one direction. It's very hard to go back to a period where you have higher embedded inflation, higher embedded interest rates, and the consequence of that. I think fundamentally that very, very loose monetary policy tamps down volatility because it's very one-directional with asset prices, generally over time. So just intuitively, you would think of the distribution of outcomes. The outcome is if we settle in with, to use James' scenario, 4% inflation, 4 or 5% rates, you're going to see a higher level of volatility than we saw through a lot of that period where money was very free. That's not certain, though, and there are other factors and other contributors, that can impact that. Policy will impact that. Economic activity will impact that. I think what we're wrestling with at the moment is there's just a lot of uncertainty as to what that path is. We all talk about the fact that we think we'll be able to navigate through. I know we'll be able to navigate through this, but the path of how we navigate through, how far central banks have to actually go to tame inflation, do they get to a resting point and make progress, or do they have to go meaningfully higher and then back up? All of those things are going to have an impact. And so I'd still say that the path, in my mind, is quite uncertain, and that will ultimately play on volatility over the next 12 to 24 months.
A bumpy road. James, anything to add?
Well, I would not underestimate the importance of a healthy banking system. I'm going to sound like I'm talking the book of the people on the podium, and I am. The capital requirements for the banks and enabling the banks to have the balance sheet flexibility to intermediate markets, which is what they're supposed to do, is essential to managing this volatility. So the wrong answer would be in a period of rising interest rates, what will be high volatility with explosions sort of in different parts of the economy, for the banks not be able to play the role that they're supposed to play in intermediating and providing liquidity for the markets. And I think that's just it's a policy issue of safety and soundness of the banking system, and you want the banks safe, obviously, and the banks are very well capitalized thanks to the last 12 years of regulatory reform. But you need to ensure that they're sufficiently sound that they can do the job they're paid to do, which is to drive economic growth through providing a balance sheet both as liquidity and for a lending product in the market.
Thank you, James. I'll certainly bring that message clear and loud to my regulatory friends in Basel. So with that, I will close the session. It's been a very great and rich discussion, which I don't attempt to summarize, but I hope that you've all gained, you've all been benefited from the insights and thoughts of our very bright minds on stage here. So I will invite you to give me a round of applause to our panelists. Thank you very much.
And thank you, Mr. Yu. Thank you to our panelists. Gentlemen, if we could get you to gather at the center stage to take a photo to commemorate the occasion, that would be ideal. And thank you again to our panelists for giving us the views that will help us to keep a firm hand on the tiller and bring our investments safely home to port. All right, thank you very much. And with that, we are going to take a short break.